A 9.4 times oversubscribed public tranche collapsed by 7.9% in a single trading session, wiping out retail capital within 3 hours of the opening bell. When the largest healthcare listing in 4 years falls flat despite millions in stabilization support, the standard playbook for retail investors is officially broken. Here's why chasing oversubscribed headlines is a fast track to becoming exit liquidity. Most financial content is built around excitement, what is surging, what is breaking out, what you might be missing. I am deliberately building something different. Retirement-grade investing is not exciting. It is disciplined, forensic, and it is designed to still be working when you need it most. As the data shows, the Singapore Exchange has seen a renewed wave of first-time share sales to the public this year. Substantial primary demand is generated in a highly controlled environment, but once the stock hits the exchange, it enters an entirely different arena, and we are seeing a repeated pattern where massive order books fail to translate into secondary market stability. Retail participants are closely watching subscription levels and cornerstone commitments as definitive gauges of long-term value, but the most recent market debuts reveal a sharp and painful disconnect. We have 2 specific case studies that establish a very clear singular pattern. First, we have Foundation Healthcare, the largest multi-specialty private healthcare platform to list locally in 4 years, which fell below its offer price on day 1. Second, we have JustCo Holdings, a prominent flexible workspace operator whose shares bled down by approximately 30% within just 6 weeks of listing. Both names demonstrate how quickly initial momentum can disappear, setting up a massive test for the upcoming $2 billion air trunk listing. Let's look at the first case study, which is the highly anticipated market debut of Foundation Healthcare Holdings Limited on the main board on the 8th of July 2026. The company successfully executed its primary capital raise, bringing in gross proceeds of $242 million, representing a massive scale for a local private healthcare listing. On paper, the primary demand looked absolutely exceptional. The Singapore public offer tranche of 87 million shares was 9.4 times subscribed, drawing more than 3,300 valid retail applications. Total demand across both international placement and retail tranches reached 3.8 times capacity, backed by 10 prominent institutional cornerstone investors like Lion Global and Manulife. Everything seemed perfectly set for a stellar performance. Despite the spectacular demand metrics before the listing, the actual day 1 trading story was a complete reversal. The counter opened its first trading session at 77 cents, which was a modest 1 cent premium above its initial public offering price of 76 cents. However, that upward momentum evaporated within hours as the equity dipped below its listing price at 10:37 in the morning. Heavy selling pressure intensified through the afternoon, pulling the stock down to close at 70 cents, marking a sharp 7.9% decline from its offer price. This severe drop occurred despite active intervention by the stabilizing manager UBS AG, which purchased 10.9 million shares in the open market. The market completely ignored the fact that $100 million was earmarked for expansion, focusing entirely on near-term liquidity instead. The massive gap between a 9.4 times oversubscribed public tranche and an immediate 7.9% price drop, especially in the face of 11 million stabilization shares bought, points to a structural disconnect in retail trading. When heavy initial demand vanishes within the first 3 hours of the opening bell, we have to look at the true intent of the participants. Were these early buyers actually investing for the long haul, or were they simply flipping allocations to capture a quick opening premium? When flipping becomes the dominant strategy, the stabilizing manager faces an uphill battle to establish a firm floor once the official price support window shuts down, leaving late-stage retail buyers highly vulnerable. This post-listing price weakness is not confined to day 1 reversals, as our second case study illustrates a slower, more prolonged bleed. JustCo Holdings Limited completed its initial public offering 6 weeks ago, raising $100 million by offering shares at 94 cents each. The company secured cornerstone commitments for 74.3 million shares, aiming to expand from 54 centers to over 100 locations by 2029. Yet, 6 weeks into public trading, the stock has repriced 30% lower to approximately 66 cents. The market is expressing deep structural skepticism about flexible office models that take on long-term lease commitments while relying on short-term corporate memberships. Even though revenue rose to $144.2 million with a cash EBITDA margin of 9.4%, and the chief executive officer bought shares in the open market, the downward momentum has not stopped. To understand why these prices are crashing, we must distinguish between the primary market and the secondary market, which operate under completely different liquidity rules. The primary market is a highly controlled environment where book building takes place, institutional allocators receive guaranteed portions, and retail bids are restricted to limited tranches. Bankers can easily manufacture a headline of intense demand by managing the supply. But the moment the stock hits the secondary market, that control completely disappears. Pricing is driven entirely by open exchange liquidity, where short-term traders, institutional desks reweighting their portfolios, and retail participants interact freely without any allocation limits. If the secondary market lacks genuine long-term buyers, the primary demand numbers mean absolutely nothing. Many retail investors see institutional cornerstone backing and think a listing is safe, but this creates a highly dangerous false sense of security. Lockup periods prevent cornerstones from selling, but they do absolutely nothing to stop other pre-listing shareholders, underwriters, or allocation flippers from dumping shares on day one. In fact, a massive retail oversubscription simply creates a large pool of smaller participants who are all looking to exit simultaneously for a quick profit. When that opening premium fails to materialize, panic sets in and selling pressure completely overwhelms the stabilizing manager. High subscription multiples are a trailing indicator of brilliant corporate marketing, not a leading indicator of price stability. The secondary market is demanding a much higher discount rate, and public investors are left carrying a fully priced stock with zero margin for error. When a company's own chief executive buys shares in the open market weeks after listing, that is usually read as the strongest kind of confidence signal available, stronger than any analyst note. But in JustCo's case, the selling continued anyway. The public market was pricing the structural risk of long-term lease commitments against short-term corporate memberships more aggressively than the very insiders who understand the business best. So the question is not whether cornerstone backing or insider buying looks reassuring on paper. It is whether either one has actually stopped the stock from falling. In this case, it has not. The window closes fast. In this unforgiving exchange environment, the difference between finding a true financial sanctuary and falling into a dangerous yield trap is decided in a single trading session. By the time this analysis arrives in the inbox of a free subscriber, the ideal entry window has already opened and often closed completely. Iggy's elite investors do not just read the reports later, they get zero-day forensic breakdowns, the full red zone watch list, and institutional-grade cheat sheets at the exact moment the setup goes live, before the market can price it in. For just $9 a month, which is less than a basic coffee and toast set at Raffles Place, you can stop being the exit liquidity for institutional players and start being the analyst yourself. This brings us to the biggest upcoming test of bourse liquidity in years, which is the anticipated listing of the Blackstone-backed data center operator AirTrunk. The trust is reportedly moving toward a confidential filing for a real estate investment trust on the Singapore Exchange, targeting a massive raise of approximately 2 billion Singapore dollars. If successful, this would be the largest initial public offering in Singapore since Netlink NBN Trust back in 2017. What we know from press reports is that the proposed asset pool is valued at $5 billion, comprising hyperscale data centers across Australia, Japan, Hong Kong, and Singapore. The trust is targeting an initial distribution yield of 6% to attract income-focused retail portfolios, with Citigroup and DBS Bank managing the launch window for September 2026. The institutional groundwork for this massive listing is already actively underway behind the scenes. The lead managers are reportedly approaching global sovereign wealth funds and large pension managers to secure heavy cornerstone commitments before any public filing. This follows the successful precedent set by the NTT Data Center REIT listing last year, which raised $773 million and demonstrated strong local appetite for digital infrastructure assets. However, as our previous case studies have shown, having big institutional names fill up the cornerstone books is only half the battle, and it does not guarantee how the stock will behave once it is exposed to the open exchange floor. The real test for the air trunk listing will not be whether the managers can put together a beautiful list of cornerstone backers or achieve a high oversubscription multiple. Given that both Foundation Healthcare and JustCo were highly oversubscribed at launch and both quickly slid below their initial offer prices, the question is whether that institutional conviction can actually survive open market trading. When ordinary retail investors and short-term traders are free to buy and sell on their own terms, the artificial demand built during the book-building phase faces real price discovery. That open market liquidity is the only number worth watching, not the initial size of the raise. Looking across these recent listings reveals a critical set of takeaways for every Singapore investor. Subscription multiples reflect marketing success, cornerstone lockups do not stop day one selling by other pre-listing holders, and book-building demand is entirely separate from exchange floor liquidity. You must form your own independent valuation rather than relying on promotional headlines. The structural gap between primary market promises and secondary market execution is wider than ever on the local bourse. Protecting your wealth requires looking past the oversubscribed headlines and conducting deep balance sheet audits before committing a single dollar. Oversubscription is a trailing indicator of marketing success. Secondary market pricing is where real conviction is tested. I am Angela. My role here is to report on analyst research, earnings results, and market developments as they stand, without applying Iggy's forensic analysis. If you're looking for Iggy's forensic audit on any of these names, that's a separate piece and will be linked where available. What you're reading here is a faithful summary of what the market and its analysts are saying, nothing more and nothing less. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS-licensed financial advisor before committing funds.
Unlocking the future of finance. Subscribe for more.